Okay, here we go. This is Russ Story. I'm about to tape Money Matters, the radio show for WDMG, your community station, as well as the station down in Tallahassee, Wave 94. We may have a couple more picked up before we have this thing going, but have it this week. But anyway, I just want to go over some things here with you. I'm about to tape the radio show, and hopefully you'll get something out of this. Been getting a lot of good comments about the Facebook Live post, and we appreciate you listening. So give me just a second. We're going to get going here, and I appreciate you being along for the ride. Okay. So. Welcome to Money Matters. This is your host, Russ Story. I'm the host for Money Matters. I have been a financial advisor for about 25 years, and we've picked up a thing or two. We've learned a thing or two, and hopefully today we're going to share with you some ideas, some things that we've picked up over the years, and we're going to talk about money and investments. Money, because money matters. So on today's show, we're kind of excited about it. We got several things going on. We're going to go over a couple of things from a financial planning standpoint. One of the things we're going to talk about, 4 signs that it's time to update your estate plan. Nobody likes talking about that. It's pretty boring and kind of wicked stuff when you think about an estate plan, but it's one of those necessary evils. And you know, nobody likes doing that research paper in school. Nobody likes doing the homework. But it's a funny thing. After you've gone in, you've figured out what you need to do, you've sat down, you've done it, you've gone through the exercise. How do you feel when you're done? You feel pretty good, right? So that's kind of what we're talking about here. And we're going to go over some signs of the times. We're going to talk about that as well. We're going to talk about an economic update. We're going to talk about some of the research that we subscribe to. We're going to talk a little bit about things that are going on in the world of economics and the economy today. I'm going to spend a little time on that. So to make sure you know who you're talking with and who you're listening to, my name is Russ Story. I am a registered financial consultant. I've been doing this for a long time. I meet every day with clients, and we try and solve tough financial problems. They may be concerning their investment portfolio. They may be over some other issues, so maybe some tax situations. Maybe they have a special needs child. Maybe they want to make sure that the spouse is taken care of if and when something happens to them. And every situation is different. Every situation is unique. But, we're going to share with you some general things here today. Hopefully, some of the stuff that we talk about today might help you and your family going forward to be better off financially. Spiritually, I hope, but financially as well. So anyway, a few things here I want to mention. September the 28th, this is sort of a current event thing here. September 28th in Tallahassee, we're having a workshop down there. I'd encourage you to sign up on the internet. Go to storywealth.com, www.storywealth.com. Go to the events tab and sign up for our seminar that we're going to have down there, Capital City Country Club, and that will be September the 28th in Tallahassee. So we're looking forward to coming down and being with you folks there. So we're excited about that. So anyway, talking a little bit about the U.S. economy. So from a 30,000 foot view, let's talk a little bit about what's going on so far this year. Well, you know, stocks really took off following the U.S. presidential election. Business and consumer confidence now kind of appears to be normalizing after generating no major shift in the economic trajectory of the United States. The current administration hadn't really put in place the tax cuts yet that it had talked about. You know, healthcare reform was something that they had committed to addressing and doing something about. And there was a lot of optimism when the current Republican president went into office. And now what we see economic data is kind of tracking this outlook. On the one hand, business investment, which is a key monitoring point has been weighing on faster economic growth, and it is showing improvement. But on the other hand, excuse me, business loan growth has actually weakened. And that's a trend especially noteworthy given today's low interest rates. You would think as low as interest rates are that, folks would be out here borrowing more money, but the sentiment levels have moderated to a more balanced view. U.S. markets have held up well, so that's a good thing. But the economic data coming in below market expectations, you have declining investor bullishness, according to some of the metrics. Equities stand at near all-time highs, valuations are elevated, and volatility is at historic lows. So that's a combination of factors suggest a market that's becoming very complacent, and investors should be wary. Complacency and elevated valuations can be a volatile mix. Now, this is something I've been talking about over and over on our program. If you've been listening to Money Matters, if you've been signing in, remember we're on WDMG, your community station, on Thursday mornings at 11 o'clock. In Tallahassee on Wave 94. We enjoy being with you guys at 5 o'clock drive time on Friday afternoons. So hopefully if you've been listening to what we've been talking about, I keep warning about investor complacency, and I keep throwing out different facts, figures, in my opinion, about how the market metrics have kind of gotten a little bit overblown. A lot of times when you have things go overly optimistic, the pendulum has a tendency to swing back the other way, and that's sort of what they're talking about here in this research that I'm going over here. Inflation, according to Manning and Napier research, they say inflation is, if it resists rising above the Fed's target of 2%, then it follows the Fed will err on the side of less policy tightening. So Janet Yellen talks about she's not too concerned about inflation, and talks about the weakness as transitory. U.S. policy implementation has been disappointing, according to Manning and Napier's research. I agree with that. I think we could have done some things concerning health care. There's no doubt we could have done a better job with maybe going ahead and getting some of these tax reform in place. But world trade volumes are on the rise. You have surging capital good orders implying business optimism, and you have international global manufacturing indices are showing growth across major market metrics. So there's a particularly attractive opportunity, we believe, in Europe, as they typically lag behind the United States. And in 2016, European equity performance lagged the United States in dollar terms for the last 6 and 7 years. So a lot of times they'll have a tendency to catch up, and some things there that are going on make more investors even more comfortable with investing in some of the Western European countries type those investments, equities, and this kind of thing. One of the things is, year to date we've seen universal improvement across the continent, and it's particularly in the core economies. Some of the core economies: Germany, the United Kingdom, France. Another thing, they've moderated a bit when it comes to the populist theme and the politics, it seems, and that tends to make global investors a little more comfortable with investing in your neck of the woods when things seem to be calmed down a bit. So that probably is going to be good. Utilization rates may lead to an upturn in hiring, but from a labor perspective, there seems to be a lot of slack. So constructive election results in France, I just mentioned that. They're talking about how that's sort of moderated with the populist theme. Although the UK is still on track to exit the euro, it seems that pro-business, pro-growth, labor and tax reform seems to be the theme right now in Western Europe. So valuations in the United States remain elevated. We see few unsustainable excesses that would suggest the economy is at risk for an imminent recession right now. But at the same time, you know, when it comes to investing, we think that discernment and being flexible is critical. So, you know, as an investor, one of the things that we always look at when we recommend different types of investments is we want to make sure that we're always able to put as many options to the investor as possible so that we can take advantage of different situations that may occur, a lot of which it's impossible to foresee. But anyway, so, you know, being flexible, I think being conservative, being diversified makes sense. One of the things I'll read to you right off Manning and Napier's sheet here, it says when it comes to fixed income, it says we continue to believe a modest duration remains in the client's best interest over the intermediate term, which we define as 12 to 18 months. We expect there to be continued pressure on interest rates to gradually move higher. We think the Fed will remain optimistic, looking to hike the federal funds rate when economic conditions will allow, while also remaining sensitive to domestic and global market conditions, particularly if they begin to reduce the size of the balance sheet. That's one of the things he talked about, and we've talked about that on this program, that the Federal Reserve, if you remember, during 2008, 2009, one of the ways they bailed out the big banks was they went in and they bought CMOs, collateralized mortgage obligations. They actually bought and brought onto the Fed's balance sheet a lot of mortgage-backed securities. And in our view, in my view personally, there's going to come a time when they're going to begin to unwind those, and that needs to be taken into consideration when it comes to fixed income. The bottom line is we believe that if you invest in equities or a type of equity, that you need to make sure that the company is a good, safe, strong, that it's able to generate stable cash flows. It has, we want things that are growth and income type investments. We're not ones to typically be aggressive when it comes to our investment recommendations. And we believe that the dividend paid by a stock or a company is going to continue to be a bigger and bigger component of total return. So that makes sense to you. We just are looking for good quality investments that have a track record of doing well over time. And if we're going to invest in equities, then I think that's kind of where we need to be. You know, most notably, in the last week or two, you began to see some volatility in the tech sector. I was listening the other day to an interview by Mr. Robert Schiller, and he talked about how he believed that this bull market in the tech sector has been brought about because people are afraid. They're afraid not to invest in technology stocks because they're afraid that that's the only way they may protect themselves against technology and these different technologies that are coming, to protect themselves and their financial future. And I guess he's saying that truck drivers are concerned that they're going to have robots that are driving big trucks down the highway, and consequently that they're concerned about that, and so they're investing in tech stocks as a hedge against losing their jobs or something. And I think that's ridiculous. But again, that's my opinion. He's a very intelligent guy, but I find it hard to believe that what he's saying in this respect makes a whole lot of sense. But anyway, taking a look at the economic data, let's talk a little bit. Second quarter employment rose to 0.5%. That's below projections of 0.6%. That followed a 0.8% rise in the first quarter. The University of Michigan's final reading of consumer sentiment in July actually dipped to a 9-month low. So in the 9 months, it topped out at 93.4 from 95.1, where it topped. So now we're at 93.2, and that is consumer sentiment. Existing home sales contracted 1.8%, annualized pace. The index has actually risen through May, but Case-Shiller looked pretty good, but index for consumer confidence reached 4-month high. In stark contrast, this Michigan Sentiment Index. So there's some conflicting data. Obviously, there's some concern out there that maybe things are kind of topping out. One of the things that we've learned over the last 25 years is nobody gets out in the street and rings a bell telling you that this is the top or the peak of the market. You just kind of wake up one day and wonder what happened. So one of the things that I'm encouraging my clients to do, and one of the things we're doing and looking at and talking to my clients and bringing them in and doing reviews, we want to make sure that we have a strategy in place and that we are comfortable with the risk we are assuming. Okay, we want to have a talk about risk. Things have gone fairly well, but it's not time to be complacent. Okay, you don't want to go to sleep just because you just had a good meal and you're sitting fat and pretty in the middle of the meadow and the sun's beating down on you, because guess what? The rain coming. Rain coming. It's going to come sooner or later. Hear me now, believe me later. So anyway, we're going to take a short break. I'm going to go over some index returns, and I'm going to talk about GDP revisions, and then we're going to talk about a couple of things concerning financial planning that you and your family may want to exercise. So we'll be right back in about 30 seconds. Give me just a second. Let me fix this. All right, this is Russ Story, your host for Money Matters. Welcome back to Money Matters, where money matters. We're going to talk a little bit about some financial planning strategies and some things that we want to make sure that you're aware of. I kind of cut it short there a while ago. I was talking a little bit about the economy and kind of what's going on, and I'm talking about some economic data. A couple things I want to share with you. This is good news, okay? By any stretch of the imagination, this is all good. If you look in the last 3 months, the Dow Jones Industrial Average is up 4.25% so far in a 3-month period. Year to date, the Dow Jones Industrial Average is up 10.46%. So in the last year, it's up 18.29%, and over the last 3 years, it's had an average annualized rate of return of 8.73. So that's not bad. If you look at some of the indexes on things like commodities and crude oil and stuff like that, crude oil, S&P GSCI crude oil index, actually over the last 3 years has dropped 21%. Year to date, it's down 7.46. The commodity index, which is Bloomberg's broad cost of commodities, actually is down 3.02% year to date, and over the last 3 years it's down 12.98%. So one of the things that I'm looking at here is an index, the gross domestic product revision. This is GDP, we call it, and basically what gross domestic product is a measure of the productivity, the production of our industrial complex. Okay, so that's one way to look at it. If you look at the previously published estimates versus the actual, there has only been one quarter, and that's the second quarter of 16, that the actual GDP numbers came out and beat what was estimated. And I don't think that's particularly a positive thing. I think that what that denotes is the fact that perhaps we have a little more optimism out there than maybe is justified. In any event, my determination for my clients and for you as well, this is one of the reasons I'm doing this today, is I want to encourage you to take a look at your risk profile, make sure that you're comfortable with the amount of risk that you've assumed as an investor, and make sure that you understand what's going to happen in the event the market goes down pretty big. You know, the fact is, the market goes down on average since 1929. It goes down about every 3.5 years. You have a downturn, and that downturn historically averaged about 35%. It takes a while to recover. Okay, it takes a while to recover, and the reality is, you need to ask yourself as you're investing in these growth investments in your 401k, in your personal investment account, in your IRA down at a brokerage firm. You need to ask the financial advisor, hey, what's going to happen if the market goes down 35%? Your financial advisor will say, well, we hope it's not going to do that. But I think that's quite naive, because the reality is every 3.5 years historically. And the fact is, it's not been 3.5 years since we've had a downturn like this. It's not been 6 years. It's not been 8 years. It's been over 9 years since we've had a market downturn. Does that mean that it ain't coming? That we got it figured out? Absolutely not. These things are going to happen. And when they do, historically, when things are put off for a long period of time, a lot of times you see them overcorrected the other way. So my point is, I would encourage you to talk to your financial advisor, whomever that may be. If you hear something on the program today, then you think it might help you, that's great. I'd encourage you to talk to whoever your financial advisor may be and talk to them about some of the things we talk about, if anything kind of rings a bell with you, and see if it could benefit you to take action. So, all right, let's see. Let's talk a little bit about your estate plan. Okay, that's always fun to do. I'm going to share with you 4 signs that maybe it's time to take a look at your estate plan. Okay, one of the things that we do here for our clients is we always try and take a look. We try to make recommendations as far as if action needs to be taken concerning their estate plan. Many times we can see that, and we will refer you to an expert, to an attorney who can do the documents for you. You know, everybody's got an excuse for putting off going to see a lawyer. I mean, everybody's got a reason not to do that. But the fact is, going to see an attorney may be painful. Maybe, you know, you're going to have to come up with some decisions that maybe you really don't want to make those decisions. Maybe you're having a hard time deciding. And it's really not the first thing you come up with when you're thinking about ways to enjoy your day. But having an effective, up-to-date estate plan, I believe, is vital to achieving your wealth transfer goals, if nothing else. It also plays a key role in minimizing federal taxes, and can do some things there where we can kind of manage some taxation when it comes time to transition assets and wealth. You know, hopefully you don't have as many court proceedings if you have a proper estate plan in place and you've executed the documents. And you know, if everything just goes through probate, it's actually public information. And quite frankly, I think your business is nobody's business except yours. If you're my client, it's mine and your business. But one of the things we always do is let people know that we keep their information confidential. Hopefully your financial advisor will assure you of the same. But let's talk a little bit about kind of what's going on. Number 1, 4 signs that it's time to redo your estate plan. Federal and state tax laws have changed substantially in the last several years. Many of you might not realize that, but the amount an individual can exclude from estate taxes goes from $2 million to $5.5 million for most couples. And over the last 10 years, a lot has changed with that. You know, there was a short period of time when estate taxes were repealed in 2010. It can get kind of confusing, but the federal estate tax rates have ranged from 0 to 50% over the last 15 years. So they've been all over the map. Recent legislation has made the amount that can be excluded from estate tax portable between spouses. Pour-over provisions in wills can be very effective. So you can simplify estate tax planning for a large portion of the folks out there listening to me by radio today. So the 2014 legislation put a schedule into motion that increased the state estate tax exclusion from $1 million to more than $5 million in 2019. It's really indexed in the law, indexed by inflation. So that's number one. Tax laws have changed since you actually put together your estate plan. And maybe there are some provisions that you can take advantage of based on the new rules and new laws that you didn't take advantage of then. So sometimes a little tweak, a little adjustment, if you will, might do it, and is all you need. But a review, quite possibly, is recommended. As you progress through life, your goals have changed. Now, I don't know about you, but I know that my goals and objectives have changed in the last 10 or 15 years. I know your estate planning goals are bound to change. Initial goals may focus on providing your spouse and kids in the event something happens to you. And that certainly makes sense. But as your wealth grows, minimizing estate taxes can become more of a concern. Older, asset protection, healthcare planning, those are important considerations as we get older. Finally, over your lifetime, you desire maybe to be charitable. And that's one of the things we, at Story Wealth Management, hope that we can get you to the point where we can help you answer the question, how much is enough? One of the things that we have looked at for many of our clients of late is when is enough enough? And what do we do once we determine that we have enough for ourselves and our children, and we got them to a point where they can do on their own, and they can provide for themselves, and they're going to have some benefit there as inheritance. Some people want the kids to get everything. Some of them want to make sure that the kids have incentive to continue to operate, work, and build and economically healthy lives going forward. We, or a financial advisor, should be able to help you determine some of these things. Your life has changed. And there's a good chance that meaningful life events may have taken place since the last time you put together your will or trust documents or whatever. And maybe some grandchildren have been born. Maybe you or your spouse have had a significant medical event. Maybe this has occurred. Maybe important people have left your life. Somebody's gotten married. Somebody's gotten divorced. Maybe life changes have had a profound impact on the way you want to structure your estate plan. Or maybe that's the case. You should at minimum review your plan after any significant what we call lifetime event. These things should be addressed and changes considered. And last but not least, your circle of trust has changed. You know, among the important decisions that you make when putting together an estate plan is that decision of who is going to help, who you're going to appoint to be maybe a financial power of attorney, or maybe that person that's going to be the custodian of your kids if something were to happen to you and your wife. Maybe this is something that you've decided on, what, you know, for minor children, this kind of thing. The name for agents on healthcare proxies, power of attorneys, living wills if you have one of those. Your spouse may be the obvious first choice in most events, but you know, you want to make sure that you have somebody that can act in the capacity in the event that you're in a situation where you need somebody to act on your behalf and you're unable to do so. So I would encourage you, given the important role that these type appointments serve and can serve and the impact that they can have on your life potentially, it certainly makes sense that you take a look and update these situations. So, one of the things that we do as well, just as an aside, we have an IRA that goes beyond just retirement savings, and it integrates some estate planning elements to ensure that your wealth is prudently managed for generations going forward. And you can learn more about the benefits of this estate planning technique, as well as some other common estate planning techniques. Give us a call. Talk to your financial advisor. If you have a question, who to call. If you have a question whether or not you need an attorney or not, maybe we can discuss it. I'd be honored to discuss you and your situation. Again, everybody's situation is a little different. So we've covered a lot of ground today. We dug in pretty deep on our economic update today. We talked a little bit about, where maybe some of the opportunities may lie going forward as far as investment opportunities. We talked about Western Europe and how they've lagged behind a little bit. We talked about the return of the indexes and the markets and kind of how what they've been up to, how well they've done. And of course, just to recap, we just talked about 4 signs that it's time to update your financial or your estate plan. So anyway, hopefully you found some of this information helpful for you. If not you, maybe a member of your family. We appreciate you listening. We appreciate you being with us today, and I hope God will continue to bless you. So hope everybody has a great weekend. Hope everybody has a lot of fun and good food, family, fellowship this weekend, and hopefully we can help you to move forward with your finances, and hopefully your things will be as you want them to be. So anyway, thanks a lot for being with us, and God bless.